So there is a concept called gross total income. Okay. So we just started. So gross total income. So we should know what is the total income of a person. Okay. Now a person can draw income from various sources. He can be working in a company, drawing salaries. He can be doing business. He can be, having some capital gain by selling some property. Okay. Or he has a property which he has, put it on rent. So he may be earning income from house property. So there are various sources. Or he may get interest from bank or dividend from companies. So there are various kinds of sources. And if you put all together, it becomes gross total income, and the income has been defined under section 14. Okay. So it has 5 heads basically. So there are 5 heads which are there, and any of the students who have already studied about income tax, you might be aware that there are 5 heads. How many students know that there are 5 heads? Just raise your hands. अभी income tax करा ही नहीं, 12th में, BCom में, कभी कुछ graduation में. So this is your graduation only, which is happening. Okay, fine. And in school there was no income tax. Okay, fine. So there are 5 kinds of income sources a person can have. Okay, in one of the year I had all the 5 sources. Okay, but normally a person would have only 1 or 2 at the maximum. So salaries, that means I was working in a company, I was getting a salary. Income from house property. So I had a property which I had let out to someone, so I was earning a rent on that. Then profit and gains of business. My father owned a business and I was a partner in that business, so I was drawing some business income also in that year. Then capital gains. In that year I sold some property and made some profit on that property, so I had a capital gain. Income from other sources, always part of everybody's this thing. He might be earning some interest on bank or dividend companies. So these are all the possible sources of income a person may have. Okay, so he has to collect all the income and then find out what is his total income and pay tax on that. So the aggregate income under these heads is termed as gross total income. First, one has to calculate what is his total gross total income by adding all incomes under all the heads which he has. In other words, gross total income means the total income computed in accordance with the provisions of the Act before making any deduction under section 80C to 80U. So, first you collect, how much money, how much salary you're getting, what's your bank interest, whatever sources you have, you just collect that income and add them up. And then there is some kind of deductions which are available to you. Okay, you can take some benefits which the Government of India has given through the Income Tax Act. All those benefits are coming under section 80C to 80U. Income tax is a very complicated act. Okay, so a lot of exemptions, a lot of deductions are available at various sections. So this is one of the main sections through which you get some deductions. Okay, suppose you want to avoid tax. Suppose your tax liability is coming 5 lakh rupees and you don't want to pay that. Okay, you can reduce a tax liability. Either pay it, don't claim any deduction, or do something under section 80C to 80U, and then you can save a lot of tax. Okay, so we'll understand those provisions today itself. Okay, some of those very important ones today itself, or maybe the next class which we are having an extra class. So by that time we will be through with all that. So what is total income? How it is computed? Total income of the assessee is a gross total income as reduced by the amount permissible as deductions under section 80C to 80U. So that means first you calculate what is your income, then applies those deduction and calculate what is your income, and that income is called the total income. So, scheme of computation of total income. Now we are talking about total income. First it was gross total income, now total income. Total income is after claiming all deductions, possible deductions which Government of India has given through the income tax. You can reduce the tax. Okay. So the scheme of computation of total income and tax liability thereon can be easily understood with the help of following chart. Okay. So I have various charts, so I try to simplify them. The first is income under the head salaries. Okay. Fine. So what I have done is basically, I'll come back to this. So I have just made this thing, which is, you can understand. So if a person is working and he is, getting salary, so basic salary, when you go and join a company, they'll say 50,000 or 1 lakh is your basic salary. Okay. Then they say you will get some DNS allowance. Mostly in government companies, to compensate the inflation, you get a DA. Okay. Or even the private companies sometimes call it a DA or by different name. Okay. So allowance to offset impact of inflation, because every year the DA is going to change in whatever inflation has happened, it will changing, so that it compensates you for the inflation which is happening in the country. Okay. Then a house rent allowance. Now a company can say that, okay, we give you 30%, 40%, 50% or whatever percentage of your basic salary as HRA. So that, if you are not working at the place where you normally live, so you go to Mumbai or anywhere in the country, so you have to look for a house and, you have to pay rent. So they say that we'll give you an HRA so that you can find a house. So that is called HRA. Now HRA is also taxable, but if you're paying rent, then there is some kind of an exemption which is available to you. You can reduce the tax. If you're not paying any rent, entire money gets taxed in your hands. Suppose company says 30% HRA, okay, and you don't pay any rent, then all will be added to your salary. Because that's a kind of a structure of a company, so they will pay HRA. Anyway, whether you stay in a rented house or we don't stay, okay, so they can't choose and pick and say that HRA is applicable to only those guys who are staying on a rent. They'll say 30% is HRA or 40% is HRA. Then conveyance allowance. Sometimes the companies give conveyance allowance, okay, because you're going to travel from your home to the company. So this is also taxable, okay, but certain amount is not taxable. Some amount is there where you can always, claim some deduction if it is used for some official purposes, okay. Then leave travel allowance. Now you might have heard that, companies give LTA, like you can travel, within the country, anywhere in the country and submit your, bills for your family, spouse and children, and then you can claim all that expense. So company says that you will be given an LTA. Okay, like, when I was working in company, so my LTA was say 50,000 rupees or 1 lakh rupees. Okay, so that was an allowance which they're giving. So if I am getting simply an allowance and not submitting any, bills for travel, then entire amount will be taxed in my hands. Otherwise, I'd say I have gone to Mumbai or anywhere, I submit those bills of air ticket or railway ticket, and those only the travel will get reduced, and I don't have to pay tax on that. If I submit some vouchers to say that I have actually traveled. Okay. Otherwise, companies say, okay, we are giving you 1 lakh rupees of LTA every year. So if you want to claim it and reduce your tax, submit those bills, you will get the exemption. Then we have special allowance. So even if there is anything called special allowance, it will be also taxable. Then bonus and incentives. Now, most of the companies, they give bonuses, okay, or performance incentives, okay, or the performance of the company. The company does well. The company declared some kind of a performance bonus. Now, when I was working in, like Idea Cellular, so I used to get almost 30% of my salary was coming through performance bonus. Okay, because every year we used to decide, how much bottom line we are going to generate. What will be our top line and bottom line. Based on that, numbers we have budgeted, if we cross them or we meet them, or if we cross them, we'll earn more and more performance bonus. Okay, it is not linked to the personal kind of a performance of the person, but it is linked to the overall profitability of the company. Okay, so then we would be having gratuity. If you work in a company for more than 5 years, then if you leave, so you get a gratuity. It is, there is a gratuity act in India which says 15 days salary for each completed year of service. So if I have worked for 5 years, so I'll have 15 plus 15 like 5. So we'll have 2.5 months salary I'll get when I leave the company as a gratuity. Okay. So normally company gives a gratuity. So there are various, that is also exempt from income tax under a certain, kind of a scheme. So normally a company pays a gratuity of 15 days salary for each completed year of service. Okay. When you leave the company, and it is applicable only if you have worked for 5 years or more. Okay. So if you have worked for 10 years, it will be 10 years. Each year, 15 days multiplied by 10 years. So 150 days salary you will get. Okay. So retirement benefits like provident fund or NPS. So, when you work in a company, so there's something called provident fund. Okay. So where you contribute some money, it's a retirement benefit. So you contribute some 10% of your salary, and employer also contributes some equal amount. So that there's a Provident Fund Act also in India, which says that, which has certain regulations. So where, the employer-employee contribute a similar amount, it goes to the to account, which is either been maintained by Government of India or by the company itself through a separate trust which has been created by the company. Where the company has no control, the money goes to the trust. And, when I was working in Reliance, so there was a Reliance Trust which was, keeping all the money, where Reliance had no, they could even draw the money, any money from there. It was the employees' money which was being kept there. So when you leave the company or when you retire, you will get all that money. Okay, so it's called the Employee Provident Fund. Okay, or sometimes there is always a pension which is created out of the Employee Provident Fund, some portion of that. So we have to go into that. So then, national pension scheme. So this is also again an initiative of the government where some money can be contributed to NPS. Okay. So so they now like employee provident fund, your employer is giving his contribution. Okay, both in NPS as well as the provident fund, employer is also giving some money. So that is exempt from tax. Though it is your income, but you're not getting it, you will be getting after 5 years, 10 years, 15 years when you retire or leave the company, you will be getting money at that time. So you don't have to pay tax in the year when you get that money. Okay, even when you get it after 15 years, it is exempt. Normally it is exempt. Okay, so that means all those retirement benefit which is the company is contributing towards your salary also gets exempted from your income. Then children education allowance. So this is also exempt, not everything. Otherwise companies can give 50,000 rupees per month as a children education. No, it is just 100 or 200 rupees that is exempted. Okay, so we'll understand what is the law there. Okay, meal coupons. Companies can give meal coupons. Okay, fine. So that is also partially exempt. Okay. Then uniform allowance. If a company provides a uniform to you, then it is exempt. But if they just say uniform allowance and don't give you uniform, then it becomes taxable. Then telephone reimbursement. It is also exempt if it is for official purposes. When I was working in a company, I joined a company called Grasim Industries, which is a Birla-owned company, and I was a commercial chief. And I was just around 27, 28 years old that time, and we were setting up a plant in Gwalior. And so we used to import things from abroad, buy our raw material from Australia and New Zealand, and source all equipment and raw material and spares and everything from all corners of India and abroad. And I was a commercial chief, so I used to make calls right from the 7 o'clock in the morning till 9 o'clock in the evening, chasing up my consignment at Bombay Customs, if that has arrived. So I'm talking to the custom agent, I'm talking to Australia and New Zealand in the morning, England in the afternoon. So I used to have a bill of about 30 to 40,000 rupees per month. So that was, telephone expenses were very heavy those days, to make international calls and national calls were, long distance calls used to be very expensive. So I got a call from the telephone department, there's something wrong with your telephone because you're getting very, very huge bills. I said, no, this is part of job, because I keep talking on the phone every time. So it was, but now if you even talk, for that time you will get just 1,000 or 2,000 rupees bill. I remember I talked for 1 hour to Chennai and I had to pay 3,000 rupees bill to the STD booth in those days. Okay. So professional tax. Now there is something, a professional tax which you pay, just 200 rupees per month, okay, which is paid to the government, state government. Okay. So that tax levied by the state government, deductible under section. So whatever tax you pay, this is also deducted and you get exemption for that. So because that's a tax which you are paying, so that reduces your income tax liability. It's just a very small amount. So then we have income from, if just go back to what was written in the original slide. So income from salaries would be income by way of allowances, taxable value of perquisites. Now a company can give you a free house, okay? So that free house is a perquisite, so we have to calculate the value of that so that you have to pay tax on that. If the government gives you a free house, it doesn't mean that you don't have to pay any tax. So it has to be valued, okay? Suppose what is a fair market value of that house, so that will be added to your salary and you have to pay tax on that, okay? So we'll understand that, how it is done. Then deductions under section 16, professional tax. If the state, you are paying state government, you get tax deduction. So there is something called entertainment allowance, which is generally by the government companies, employees, they get. So, so that allowance is also deductible. So if the government employee is getting some entertainment allowance to, for, because he is meeting so many people and he is spending some money on the restaurant bills, or so he will be allowed that, he will get some allowance. To some extent, it will be exempt from his salary. Okay. And there is something called standard deduction. So this is very important, standard deduction. So all salaried people, they are getting a standard deduction of 50,000 rupees maximum. In the next year, it will be 75,000. This year, for our purposes, it is 50,000. But next financial year, that is 25, 26, for whatever income we will be drawing in that year, the standard deduction will be 75,000. It is only for salaried people, okay, or pension. So this is all income from house property. That means you are having a house property, whether it's a commercial property or a residential property, you have given it in rent to someone and you are earning a rent. Like, I own a property in one of the mall where I've given to Pizza Hut. So they are giving me 1 lakh of rupees per month. So that 12 lakh rupees, I have to pay tax on that. So that will fall under income from house property. Okay. So income from house property. So, there is a reduction under section 24. Like suppose, that if I am getting a lakh of rupees per month, so it comes to 24 lakhs. There is a reduction of 30%. That means 30% of 12 lakhs, that is 3,60,000 will be reduced. Rest on that I have to pay tax. So that is called maintenance allowance. Because, I have to maintain the property, whitewash it, and, there can be a lot of things which I have to do to, maintain that it is, the tenant can keep using it. So straight away I get about 1/3. Income tax is not going to ask how much you have spent. So it's a state deduction under section 24, which is 1/3 of the rent which you are getting. Or, of course, there is always a calculation, so I'm just roughly it is like that. Okay. Fine. So income, so whatever you get income from house property. Assuming if I get lakh of rupees, so it is 12 lakh, and because when you own a property, you have to pay some municipal taxes also on that. Okay. So first that is deducted, then you get 1/3 deduction, and rest is taxable. Then you have to pay tax on that. So this is. Then we have, if you look at this, income from house property, gross annual value. First, you have to calculate a GAV, which is total rent received or receivable annually from a property. So first of all, how much rent you can receive or whatever you have received. Okay. Like suppose you have fixed a rent of 1 lakh rupees, but you have got only 11 lakhs. 1 lakh still the company has not paid, but you have to pay tax on 12 lakhs only, because you may get 1 lakh, and because it is on accrual basis you have to pay. Okay. Even if you not get it, you have to pay a tax on that. You have to calculate your GAV for 12 months only. Then of course you can claim that you have not received that rent, somewhere bottom line. Then municipal taxes, if you have paid something, that will be deducted. So then it will be net annual value. So GAV minus the municipal taxes will become taxable in here. All rent minus the municipal taxes, generally is a very small amount, deduct that. So that is taxable. Then from that you get a standard deduction of 30%, which I told you. Okay. Then you get interest on home loan. Suppose you have a house, okay, and you are giving it on a rent to someone. Either you have let it out or you are using it on self, and you have taken a house loan. Normally a person will always take a house loan and he has to pay interest to the bank. That interest which you pay is exempt. Okay, that reduces your tax liability. Suppose you are giving it on rent to someone. There's a house property, you're giving it on a rent to someone. Okay. Now, whatever interest you are paying on a home loan, suppose it's a residential house, and you are paying interest on that, it will be exempt. If it is it is using for your own self-occupied property, then maximum deduction you get is 2 lakh rupees per annum. But if it is let out, then entire amount. It is even 5 lakhs you are paying interest, you will get 100% reduction. So I will talk about that more. I'm just giving you a little bit idea about that before that. So there are some deductions which we will be remembering them, okay, while we make our calculations. They are normal, which everybody comes across in his life, okay. So we are going to talk about only those deductions, okay. Then unrealized rent. Suppose the landlord has not and is disputing, okay, he is not paying. So you can claim a deduction on account of that. I have not got this, though my rent is a lakh of rupees per month, it should be 12 lakh, but 1 lakh I am not getting it. So I am going to pay tax on 11 lakhs. So unrealized, so you have to mention that, okay. Then areas of rent. Suppose you get a rent in the next year. Suppose in this year you claim this as unrealized, next year he pays it. So include that in the year when you get the money, okay. Then self-occupied property, property occupied by the owner, GAV is considered 0. If you are owning a house, then there is no rent earned, so that means your gross annual value is 0, you don't have to pay any tax, normally, okay. Fine. Logically is that if you own a house and you are staying there, why should you pay a tax, okay. So in that case, the government says that the gross annual value is 0 in that case, but you can, if you have taken a loan, okay, and you are paying interest on that, so you will be allowed interest. So in that year, you will have a negative income from house property. It will reduce your income tax if you are making a salary income, okay. So you can claim a set off in that year. So it will reduce your income tax. If you are staying in your own house, you're not getting any rent, but you have taken a loan from a bank and bank is charging interest on you, okay. So that interest up to 2 lakh rupees, this is a ceiling, you can claim that in your return. So in that year, you will have minus 2 lakh rupees as income from house property. But suppose you have 50 lakh rupees income from salaries, so your income from salary will get only 48 lakhs and you have to pay tax on that. Fine. So you get a deduction. Then let out property, rented out, GAV is actual rent or fair rent, whichever is higher. Now, why it is written is that sometimes, person may say that I have given my house on rent. Okay, please listen to me carefully. If I have given a house on rent, I am getting a lakh of rupees. But actually, that house can generate a rent of 2 lakh rupees. What I'll do, I'll just ask the landlord, pay me 1 lakh rupees in cash and 1 lakh rupee check. I want to avoid income tax. I can do that. But income tax says that it should be the fair rental value or the actual rent. Whichever is more, you have to pay tax on that. To avoid such kind of circumstances where a person can always reduce his tax liability, so government can say that property rented out, GAV is actual rent or fair rent, whichever is higher. So we have to calculate what is the rent, fair rent prevailing in that area, or by the municipal corporation, what is the rent which is fixed for charging house property, because these people are collecting some taxes, so they also calculate what is the fair rental of that. On that basis, you have to pay tax to the municipality. Okay, so either that or the rent which is the fair rent prevailing across that area. So you have to just give all the number by yourself. Okay, you self-declare it. This is the rent which I might have got it, and this is the rent what I am getting it. If there is a vast difference, if the fair rental is higher, then you pay tax on the fair rental, because then you can't avoid it. Government is not going to ask what is the fair rental, only unless the income tax officer is going to call you and assess you, then he can ask for you for other details. Otherwise, you have to self-declare what is the fair rental of that property. Certify yourself, okay? And you say, I am getting the same, then it's okay. If the income tax officer is not satisfied, he will just send you a notice, come, because you are declaring your rent, okay? Because the rental property income, other people are saying the rent is 2 lakhs, but you are saying only 1 lakh, because they get return from all the sources, so they can always, because everything is now digitized, so they can come across and find out whether you are correctly mentioning of that. Now, then pre-construction interest. So suppose if you have made a house and you have taken a loan, it is under construction. Okay, you have been paying interest to the bank, and the bank is charging interest. Okay, but the house is under construction. So after construction, suppose you let it out. So whatever pre-construction interest you have paid till the time that also you can claim, but in 5 installments. In 5 subsequent installments, you can claim all that interest, okay, which you have paid before letting out the property. So in that particular year, you got the rent. So you have paid interest accumulated over the last 4-5 years or whatever. You can claim that in the next 5 years. Okay. So we'll talk about that. Okay. So interest paid before possession, deductible in 5 installments. So if you got a house from somewhere, before possession means that you have got it from either from DDA or from authority or from a builder. So whatever interest you have paid to the bank, you will get an entitlement. Then co-ownership income. Suppose the house is owned by 2 people, brother and sister, or 2 brothers. So they can segregate and pay taxes on their own income. Okay. Then vacancy allowance. So that means that the house has remained vacant. Suppose the fair rental is, say, so much, because you have to pay either actual or fair. Okay, but there can be the house was vacant also, so you can claim a vacancy allowance. On that period, there was nobody who was staying, so you can claim an allowance for that. So reduction in GAV, the property remain vacant for part of the year. So because there is a set computation mechanism, so you have to calculate what was the rent you could have got it. But you got it less because the house was lying vacant, so you can claim the deduction. Then we come to profit and gains of business and profession. So straight away I'll go here. So profit from business and profession, it is like this. First you look at what is your top line. That means how much products or goods you have sold, what price you have charged, or you are getting some service revenue because you are a service provider like Idea Cellular or a Vodafone. They are not producing anything, but they are selling their mobile connections and they are getting income. So either it will be a manufacturing company or a retailer or a service provider. So there will be something called gross receipts or turnover. This is the sale of the company or the revenue of the company. Okay. First. Second, whatever the cost of goods sold, minus it. Okay. Ultimately, you have to arrive at a net profit. On net profit, you are supposed to pay a tax. All companies, all business people, they have to submit a profit loss account, and first they have to declare what was my total sale, what was my expenses, what is my net income. On net income, you are supposed to pay tax. So let's understand that. So cost of goods sold, deductible. So then you get a gross profit, which is taxable. From gross profit, your salaries, rent, all operating expenses, you will get a deduction. Then depreciation as per income tax rules. Okay. Now, as per income tax, there is depreciation rules are there. For all kinds of asset classes, there is a depreciation rate given. Okay, like for building, it is 10%, for example. Plant and machinery, it depends upon what kind of plant and machinery. It can be 15%, it can be 20%. On computer, it is as high as 60%, because computers go obsolete in just matter of 1 or 2 years. So income tax has specified various rates of as deductions. Okay, so when you spend the money and buy an asset, you don't get an expense, a capital expenditure. So on that you will get depreciation. Every year you can reduce your, you can recalculate your profits based on the depreciation and pay tax on that. Now, because in Companies Act also there are rates of depreciation. So under Companies Act there is a rate of depreciation. Under income tax there is a rate of depreciation. Now companies which are registered under the Companies Act 2013, which is a company itself, Companies Act. So all the companies which are listed in India, they have to make their profit loss on the basis of the depreciation which is given under the Companies Act. Okay, because Companies Act says that you have to charge depreciation as per the Companies Act. If there is a profit, then you can declare that as some dividend if you want, or pay some money to your directors on the basis of profit what you have earned. Okay, so just to regulate that no company is paying any money as dividend, even they are not earning any profits. So the Companies Act says, number one, for declaring any dividends, you have to charge depreciation as per the Companies Act. Before you give any money to the directors in lieu of some percentage of profits to the company, you have to calculate profit on the basis of the depreciation rates which have been specified under the Companies Act. But income tax says that before you pay income tax, you have to charge depreciation as per the income tax rules. So now what you do is you add back the depreciation as per the Companies Act and reduce depreciation as per income tax and calculate your tax liability. Okay, so you arrive at a net profit of the company, add depreciation as per the Companies Act minus depreciation as per the income tax, and then pay taxes on that. So this is a normal format which all the companies follow. Okay, fine. So पहले आपको depreciation add back करना पड़ेगा जो आपने Companies Act के हिसाब से provide करा है for purpose of calculating tax. Okay, then reduce the tax as per the income tax and then pay the tax. Okay, fine. So depreciation deductible as per the income tax rules. Okay, then interest on loans. Suppose the company has taken loans from bank for carrying out the business of buying equipment, plant and machinery, so that interest is also deductible as an expense. So all interest which you pay on your loans to run the business is also reduces your tax liability. Then repair and maintenance. So if you carry out a repair and maintenance of your plant, equipment, building, assets, whatever, so this is also going. Legal and professional services. Suppose you are hiring a lawyer for defending yourself, so those expenses also are deductible. Then bad debts. Suppose when you sell your goods. Okay, you sell your goods and some customers don't pay your money to you. So those are called bad debts. Accounts padi. So you make a provision of this thing. Provision is not allowed. Only actual bad debt which you have deducted and reduces your customer's account, that is only allowed under income tax. No provision has to be reversed back. If you calculate your profit after the provision, so that should be added back before calculating your tax liability. Because when I was working on Idea Cellular, so we used to have a lot of customers, postpaid customers. Prepaid customers pay upfront, but in those days there are almost like 70% of our customers were postpaid. Okay. So so 70% of the customers were postpaid. So we used to, a lot of customers, we used to find they were not paying their money. Okay. Pranav, you just told me. So meeting ho gaya aapka? Okay. So when I was working at Idea Cellular, we used to have lakhs of customers postpaid. Every year, every month we were submitting bills to them and giving a due date to pay the amount, 1,000 rupees, 2,000 rupees, 500 rupees, depending on how much phone you have used. So we will find that a lot of customers are not paying. Almost like 2 or 3% customers are not paying. And what was their problem? That they have got higher bill. They have not made any calls, but they are still, but there will be normal complaints. Or they say there is no network in their home. Why should we pay? So these are kind of, normally a customer would have a, issue with the telecom people, and those problems were there, plenty of them in those days, okay, when we started, telecom in India. So we used to make a 2% provision on the entire bills which we have raised to the postpaid customers. Suppose we have made 100 crore rupees billing to the customers, we'll say 2 crore rupees provision. So that means our income will get reduced by 2 crores in that this thing. For Companies Act purposes, it's fine. For paying dividends, you can claim that 2%. But for tax purposes, that 2 crore was supposed to be added back and you have to pay tax on the full amount. Unless you have just written it off the customer. Now, if you have made a provision, that means you are not writing off any customer. You are still chasing up, calling the customer to pay, bhai, pay karo. Aapko kya problem, we'll just correct it. Some customers will not pay because they had a problem, a network problem. So they say, we are not going to pay at all. And once you have identified this customer had a network problem, so you have to make you have to write it off that customer. So once you write off, only the amount which is written off is allowed as deduction under the income tax. If you have not written off, you have just made a blind provision saying that this much of you are not going to get. It is just a a conservative way of calculating your profits. 2% money to गया नहीं आएगा, वो अलाउड नहीं होगा इनकम टैक्स. इनकम टैक्स में वही अलाउड होगा जो आपका एक्चुअल आपने डेबिट कर दिया. यू हैव रिड्यूस योर कस्टमर्स अकाउंट टू जीरो. ओके, so bad debts if written off in the books, deduction if conditions are met. Okay, that means you have written off, you have sent a letter to your customer, bhai pay kar do, nahi pay kara, write off kar diya, allowed. So these conditions are there. Income tax will say, okay, you have written off, but you have not even reminded your customer even once. Show us, a proof. Fine. So you have to keep all the proofs ready if the income tax department asks. Okay. Then income from other sources. So that will, if they are related to business, fine. So that will be taxable under the head income from business sources. Otherwise, it will go to income from other sources, which is the fifth head. Okay. Then net profit. Net profit. On net profit, you are supposed to pay tax. Now, after you have arrived net profit, you have to make some adjustments. Disallowance expenses. Some expenses will be disallowed. Okay. Like suppose, a director has traveled abroad along with his wife. Okay. So the wife's travel expense will be disallowed, though it has been shown as an expense in your business income, expenditure in your profit loss account, disallowed. Because that is not an expense which is allowed. That's your personal expense. Similarly, there are a lot of expenses which are debited in a profit loss account, which the income tax rule says that disallowed. Suppose the money is paid to your, a relative of a director. Okay. Then under some circumstances, whatever salary you have paid to him, it will be disallowed. We'll understand that later on. But all relative transactions or related party transactions can be disallowed on certain conditions. Okay. So all disallowances expenses will be added back to the income, and then you have to calculate the income, your total income, and pay tax on it. Then we have capital gains. So capital gains would be, if you have a property which you sold. Suppose I had a piece of land or a building and I have sold it. I sold it for say 1 crore rupees. So full value of how much I have received, first I write that. Then cost of acquisition. That means at what price I got that building. Suppose I got it for 50 lakh rupees, I made a capital gain of 50 lakh rupees. So I have to pay tax only on 50 lakh rupees, not on 1 crore. 1 crore was the sale price of the building, 50 lakhs I bought. So cost of improvement. Suppose I added another 1 story on the building. So any improvement which I have done and I have spent 10 lakh rupees, so that will also get reduced. So I have to pay tax after claiming that reduction on account of any improvement which I have done on a building. Suppose I am saying building, I am just giving it applies to all kinds of assets. Then expenditure on transfer. Suppose when I am selling the goods, I am selling my property, so I am engaging a broker, he is charging some fees from me. So all those fees or some government charges which I am paying, I will be allowed at deduction. So rest will become my income. Is that okay? So net taxable capital gains, taxable. First take the entire amount. Of course, we are going to study this more in detail because each chapter is a separate chapter by itself. I am just giving you, when we arrive at capital gains, when we arrive in salaries, when we arrive at income from other sources, income from business provident, we are going to study everything in detail just to take you that this is how the income tax has been set up. Okay. So net capital gains. First take the entire value minus at what price you purchased that property or shares or whatever. It's a capital gain, can be provide shares also. You bought some shares of Reliance and sold it. You bought it for 1 lakh, you sold it for 10 lakhs. So 9 lakhs is a capital gain. So for that purposes, you have to compute your tax liability for all kinds asset classes. Okay. And normally the schedule is like full value of consideration, cost of acquisition, at what price you acquired. Then if you added some more improvements to that, so do that, that will normally arrive at a building. Okay. Then expenditure on transfer, that means brokerage, legal fees you paid. So that will be your expenditure. Then net capital, gains. Okay. Then you know, ultimately you will arrive a number which is a capital gain. Now, capital gain can be either a short-term capital gain or a long-term capital gain. Suppose you had a building which you owned that building for more than 2 years and then sold it. So it's called long-term capital gain. But if you bought a building for 1 year and then sold it, or less than 2 years, it's called short-term capital gain. On short-term capital gain, you have to pay a full tax. On a long-term capital gain, you have reduced tax liabilities. अगर आपने कोई asset, shares, or any building you have bought and sold and you kept it for a long period of time and then sell it, so you will get a lot of benefits. But if you bought it and sold it in a jiffy, then you pay full tax. Okay? Like short-term capital gain, so your tax slab rates, you have to pay as per slab rates. Like, you know, up to certain amount, I'll show you the tax rates. On that, you have to pay tax. On the normal tax. Okay? But if you are long-term capital gain, then you have to pay only 20%. The maximum tax can be 30% under a slab rate, isn't it? जो slab rate का maximum tax है 30% है. But if you have, suppose you are on a 30% tax bracket, but if you have sold some building or shares, you have to pay only 20% or 10% without indexation. Okay? So either you have to choose between two. You pay 20% flat or say 10% after claiming indexation benefit. So there is an index, you know, which is given by the Government of India through Income Tax Department, which says that, you know, every year there is an inflation which is happening. Sometime it is 4%, sometime 5%, so they maintain a chart. So you have to pay tax only after adjustment of hello, हाँ, किस लिए? नहीं नहीं, नॉट एट ऑल. ड्यूटी के लिए कोई नहीं देता. ड्यूटी के लिए हाँ, दूसरी नहीं 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 कोई नहीं. So either you have a long-term capital gain or a short-term. This is very important. Okay. So if it's a long-term capital gain, then you have to pay tax either 20% or 10%. 20% pay kar do. Forget the indexation benefit. Indexation is like this. You know, suppose you bought it some property at 100 rupees, and you are selling it after say 3 years. So every year, suppose there is a 5% inflation. Assume that, hypothetical. That means the property value today is 115 rupees when I'm selling it, isn't it? 5% inflation हो गया, तो 100 रुपए की बेची और 115 में बेच दी, तो I don't have to pay any tax because 15% was the inflation. So whatever money I am getting, it is compensating me only for inflation. I am not earning a real income. So that is called indexation benefit. So there is a chart which you follow and calculate how much was the inflation and how much you earn more than inflation, you pay tax on that. Is that okay? We'll understand that later when we come to. So if you apply the indexation, then you pay 10%. But if you don't want to claim any indexation benefit, pay 20%. Say I don't want to claim any indexation benefit, pay 20%, other 10. Then index cost of improvement. So okay, attendance लगा लेते. Okay, just 2 minutes के बाद. Let me just complete this. Okay, then कितना time मिलता है? हाँ, 10 मिनट मिलते हैं. Just 5 minutes I'll take and then you can just rush to that. So you know, when you sell a property, you have made a huge money and you don't want to pay tax, neither 10% nor 20%. So there are two ways through which you can make an exemption. You buy another property, another residential property, okay, within a certain span of time. If you do that and you spend most of the money which you have gained, you will be exempt from tax. And all those exemptions are given under section 54, or deposit money under the capital gains account, where there is a lock-in for 5 years, 7 years, and the money gets blocked for 7 years. You can't withdraw it, okay? Then you can avoid the complete taxation also. But the maximum you can do is 50 lakh rupees, okay? Just listen to me. So we are going to study all that. I'm just giving you a little bit about that, okay? So if you have sold some property and you have earned a huge amount of money, then you want to save it, okay? So you deploy it somewhere for buying another house property, okay?
So
Fine.
but buying we have to pay tax, right?
No, on buying you don't have to pay tax. Buying you have to pay the price for the house, okay? So suppose you have sold a building for 1 crore, okay? You have 1 crore with you and you bought it for 20 lakhs. So you're sitting on a capital gain of 80 lakh rupees. So if you deploy entire 80 lakh rupees in buying another property, then you don't have to pay a tax. Or you can deposit 50 lakhs under the capital scheme, so you can reduce your tax liability to.
So sir, why will someone take the benefit of 20% when he has an option of 10%?
हाँ, वो अभी देखेंगे ना. We just calculate both ways and say which is more beneficial. Whatever is more beneficial, you pay that. Okay. Okay, Pranav, I'm just going to. Okay, just now go and take your attendance. Pranav, you had a question. Yeah.
Lock-in period, right?
Huh?
You said a lock-in period for 5 to 7 years.
Yeah.
So in that, do we earn any interest or something?
Yeah,
or
4.5%.
Okay.
Depending upon the interest scenario, nowadays it is around 4.5%. It's very less. Fixed deposit you get 7%,
Yeah.
but on capital bonds you get only 4.5%
That's
nowadays.
what I wanted.
Yeah. I'm going a little faster, but actually we will be doing all this in more detail under each chapter. 1 3-hour session for each head we will be spending at least. Okay. So remaining would be maybe about 6 or 7 or 8 sessions left, where we will be covering each and every head. Okay. So then we have the final one, income from other sources. This is the 5th head. Okay. Fine. Under the 5th head, what is there? This is the residual section. Just focus here. Interest income. Suppose you have a fixed deposit or a saving account, okay, and you are earning an interest. Because if you have an account and the money is parked, either it is a saving account or a fixed deposit account, you get some interest from the bank. So that is coming under, which is taxable. Of course, you get some exemption. Under section 80T, up to 10,000 rupees deduction is given for any interest which you earn under the saving account, but not under fixed deposit. We'll understand that also, because that is will be coming when we're doing section 80C to 80U, those sections. So we get some exemption there. So not entire amount is taxable. Whatever you get as saving interest, some is up to 10,000 rupees is exempt. Okay. Then dividend income. So dividend income is also taxable. Okay. When you buy a share and you're getting some dividend from the company. Then rental income from machinery, plant, and furniture. Suppose you have some furniture and given rent to someone. Okay. Like suppose you have a house, okay, and you want to give it on rent to someone, and the rental, and it is fully furnished. So you can just break it up, house rent and furniture rent, so that you can always save some income tax if you want. We'll understand how you can do that. So if you are earning by renting out some furniture or some machine, some equipment, that will become income from other sources. Winning from lotteries, horse races, etc., everything is coming other sources. Okay. If you're making if you're gaming, you're playing a game or online or this thing, so it will be from lotteries, races, etc. will be, and the tax rate is 30%. Here you don't get any reduction. So entire money which you're earning to these sources, you have to pay 30% tax without any benefit. Okay. Now, if you get a gift from someone exceeding 50,000 rupees, you have to pay tax on that. Okay. Fine. But if it is coming from a relative, like your brothers, sisters, then you don't have to pay any tax. Okay. If the money is coming from any other source, more than 50,000, you have to pay tax on that, on the entire amount. Okay. Suppose I give you 60,000 rupees, you have to pay tax on that. Okay. But if I give you 25,000, then you don't have to pay any tax. So gifts exceeding 50,000, taxable. Okay. I'm just leaving this. So then we have the gross total income. Okay. So then you arrive at the gross total income after having calculated. So it will be income from salary, income from house property, profit gain, capital gain, and the gross total income. Is that okay? Now, if you have suffered a loss in the earlier years, you can claim that loss also. Suppose last year you suffered a loss of 1 lakh rupees, either from your business income or from house property. You can claim in the current year and reduce your tax liability. Okay. Then we come to, okay. So this was, I can't skip that. Okay. So gross total income, less deductions under section 80C to 80U, which we are going to understand. You get total income. Then you calculate your tax liability. Tax on net income, rebate under section 87A. So there is a rebate which is given to all the people who are drawing up that if they have a, now you know the you know this time the budget was announced is anybody who's having income up to 12 lakh rupees there is no tax. So they get under a section, anybody who's getting 12 lakh rupees income or below, there they will get a deduction under section 87 so that they don't have to pay any tax. Last year it was 7 lakhs. We will be doing some question on 7 lakhs, but next year it will be 12 lakhs. Okay. So that exemption is under section 87. Okay. Then after, if there will be some surcharge will be added to your income. If you are drawing an income above 50 lakh rupees, अगर आपकी इनकम 50 लाख से ऊपर है, then you have to pay a surcharge also. We'll understand what is surcharge. Then, so you will have tax and surcharge. Ultimately, you have to pay tax and surcharge on your income. Okay. Then you have to add 4% cess. Once you have calculated your tax liability, you have to pay 4, उसके ऊपर 4% cess, education cess जो है, that is again a government levy. So if you have paid some taxes earlier, like you know when I'm offering my services, so my money, when Shivnadar is paying to me, they deduct tax on my, that's called TDS. Okay, so I can claim, you know, a TDS deduction and pay the tax liability, final tax liability. And as any person in India, you have to pay advance tax also. Okay, so almost 90% of my money should have been paid before the year ends. That means before 31st of March. And there are 3 installments for individuals: 15th of September, 15th of December, and 15th of March. So I have to keep paying that amount so that by the year ends, it's only 5 or 10% which is left I need to deposit along with my tax return. Okay, fine. So this is how you calculate, and we will do this calculation under Excel sheet. Okay, in the evening, we'll solve some questions possibly. So then there is a rounding off which you can just read it yourself, but I'll come back to this. So, so just before we calculate, so computation of tax. So we'll talk about the individuals, okay? So individuals, HUFs, AOPs, BOIs, that means all these people have the common taxation structure. Whether you're an HUF or individual or a body of individual associated person, there is only one tax rate. So there are 2 regimes, okay? I'll just cover this in next 5 minutes and close it, okay? So there are 2 regimes, old regime and new regime, okay? Fine. So government of India wants that everybody should migrate to the new regime. There, they are more liberal. Okay. Old regimes, you get a lot of benefits. In new regime, those benefits are all taken out, but you have to pay less tax. Okay. So we'll understand that. So the default tax regime is new regime. So if you have not opted for any regime, you have to pay tax as per the new regime. Otherwise, if you find the old regime is beneficial, you can opt out for old regime, okay, before you file your income tax return. So I'll just show you the, okay, so this is the last slide. So this is under the new tax regime, these are tax rates, okay. So up to 3 lakh rupees, this is for this year. Next year, this figure has gone up to, this chart has become better and you have to pay less tax. Up to 3 lakhs, nil. 3 to 6 lakhs, 5%, 6 lakhs to 9 lakhs, 10%, 9 to 12 lakhs, 15%, 12 to 15 lakh, 20%, above 15 lakh, 30%. So this is the tax. These are the slab rates. Okay, fine. If you are drawing a salary of 3 lakh rupees or income of 3 lakhs, you don't have to pay any tax. But there is a section rebate under section 87A, which says resident individual with a total taxable income up to 7 lakhs, they will get this rebate. Which is how much? Suppose you are getting 7 lakhs in income, okay? So how much tax you are supposed to pay? Between 3 to 6 lakhs, 5%. Suppose on 3 lakhs, 5%, how much comes to 15,000? And on the additional 1 lakh, you have to pay 10%. So 15 plus 10, 25. So you get 25 deduction here. So up to 7 lakh rupees, you get additional 25,000 rupees deduction so that you don't have to pay any tax. Next year, this figure will go up to 12 lakh rupees, okay? Fine. So this is the slabs in India. So this is the new tax regime. The old tax regime was this. So either you pay taxes according to the new scheme or as per the old scheme. Old scheme says that you have to pay tax if your salary or income is above 2,50,000. Not salary, but income. From 2,50,000 to 5 lakhs, you get 5%. From 5 lakhs to 10 lakhs, you have to pay 20%. From above 10 lakhs, you have to pay 30%. So there are 2 slabs, 2 tax rates. You have to choose any one of them and pay tax accordingly. But if you choose this, you will get a lot of benefit from 80C to 80U. But all those exemptions have been withdrawn under the new regime because the government says that they can't keep giving all the deductions to you. Okay? They want to move away from a place where you're paying full tax and not claiming any deduction. That is the ultimate theme of the government. So because we had a system through which you can claim so many deductions, so many exemptions, so you can always reduce your tax liability, okay, and pay nothing to the government. The government says we are making the tax system very liberal so that up to 12 lakh rupees from the next year, you don't have to pay any income at all, okay, any tax at all. But you can't claim any deduction. So in the evening, there's an Excel sheet where I'll show you how it is done, and we'll do some question and calculate tax for both the schemes and find out which is beneficial to you and choose that out of it. Okay, fine.